Hey traders, welcome to Charts and Coffee. Happy Thursday morning. We are just getting the PPI data. Oh, I shouldn't say we're just getting. We got it 30 minutes ago. And you can see the candle right there. That 8:30 candle, that's the PPI data. Now, not an inflation metric on par with, say, the CPI or the PCE. I know it's an alphabet soup of data out there, but anything that tends to give us some insight into something like this, the price of goods, the price of the things that make the goods, PMIs, PPIs, they're going to fall in the inflation bracket of things. And because of that, there'll be some insight into, well, what's the Fed going to do next? Because everything maps to this little data point here, this little comment there, this interview there, this speech over here. It all maps to what is the Federal Reserve going to do next. Now, it was really interesting. I listened to a lot of what Powell said. I was in the Sector Secrets Mastery room yesterday. We were sending some setups out with some of the volatility of that, before the press conference, we have, of course, the pre-event, the rate statement. And then after the press conference is done, that's when we start to see the follow through. And in that weakness, we started to buy some things. Now, ultimately, what we want to remember is, and I thought it was very interesting. I thought Powell was being asked questions where he had to defend just how dovish the Federal Reserve was. And he even commented on the four members, because they then itemize the members and say, hey, what do you think? Where should we be? And four of them said, we're not gonna cut this year. And everyone just took that as being so dovish. And then Powell said, in not so many words, really pretty frankly, and in English, I thought pretty plain spoken English, that that's not necessarily the consensus of the group. And then when I listened to the television station, pick your financial media nonsense on TV, and they were saying, they sounded so hawkish and they were not that dovish. I'm like, what were you all listening to? And who cares what's being said, right? If you're wondering, Rog, I really wasn't sure what to take away from the rate statement or even whatever it is that Powell said, because, they're always going to hedge. They're going to say something a little dovish. They're going to say something a little hawkish. They want to keep the scales balanced because they do not want to paint themselves into a corner. They don't want to commit to the cuts too strongly, but they don't want to back away from them too much either. So if you felt like you were dancing with Powell during that press conference, that's the idea, right? But we also know there are ways we can measure what's being said. Look at the bonds, look at the euro, look at the Fed fund futures, look at the indices, and the two indices that have remained in uptrends. And lo and behold, right? And there was all sorts of doomsday nonsense on whatever boobs were on television talking about the press conference after. And here we are, kind of still levitating up near higher highs. I know, calamity, right? But this is the game we play, right? This is the game we play. This is the game of, we know we can keep you tuned in if we scare you or confuse you just enough. I know, I woke up salty, I guess. But I listened to, and I made the mistake of unmuting financial television, and I was promptly reminded how ridiculous it is. So their job is to sell advertising, and the best way to do that is keep you tuned in, and the best way to keep you tuned in is to scare or confuse. And boy, I can see why people stay tuned in, right? It's amazing. So there you go. That was yesterday's event. And oh yeah, we're not sitting at, I don't know, what's the number out there that we're supposed to collapse down to? Can someone tell me? Where are we supposed to just collapse down to? I've heard everything from 5,000 to, yeah, really? 5,000, is that the number that's out there? SPX or S&P 5,000? Yowza. Okay. So let's do this. Just every now and then, it's good to have a little bit of a reality check, yeah? Okay, we like to call it a sanity check. I'm warning y'all, I'm salty this morning. No, I'm just really, really amused by this game that we've all chosen to play. All right, here we go. So here's something we call the sanity check. To get down to, let's pull up the S&P. All right, so let's do this. ES, let's take a look at a sanity check. All right. A 10% pullback would get us to 49.09. A 5% pullback would get us to 51.81. Just to give you a perspective, right? Let's use something else where we're looking at, a very moderate pullback after the split. This is NVIDIA. NVIDIA pulled back just over 5%, but not quite to 10. Now, I know these numbers are a little off, but this was pre-split, and it pulled back about 7%, right? And then it bounced. So 5% is not an unusual amount to pull back. So when people throw numbers out there, try to ask yourself, if we're going to pull back to 5,000, that's a pretty big pullback. That's nearly 10%. Is that likely? And then here's the next question. What would be the catalyst from which we could trade it? Because remember, targets are not trades. If I go out there and say, it equally dumb would be for me to say, hey, we're going to 5,700, right? So let's take the dumbness on both sides. If I say we're going to go to 5,700, Rob, what's the catalyst for that? By the way, that's at least a more logical number because we're in an uptrend. So the path to higher highs is already set and it makes more sense. I'm not saying we're going to 5,700, but at least I'm picking a target above, right? But to pick a target below, one that would take us down to where we were at the beginning of May, right? So one that would take us down to, we would have to see something on par with what we saw from April to May. So some folks might say, but Rob, we've seen this before. We've seen a move of that kind of magnitude. So what was the reason for that move? So from January to the end of March, expectations were that the Federal Reserve was going to cut 3 to 4 times. That's a lot, a whole 100 basis points. One full percentage point lower by the time we get to December, if not more, right? And then all of a sudden we realize, oh gosh, we'll be lucky if we get 1 to 2 cuts. So the market responded. So yes, there is a possibility that the 4 members that were, they tally that up in that whole package of information with the rate statement. There's a possibility that those 4 members are right, and the Federal Reserve is not going to cut. That is what we would need. But in the meantime, do you really want to pick a top? Do you really want to say, well, Rog, this is it. This is the end of it. How many times have we heard that? And the reason I'm trying to say this as strongly as I am is because all-time highs are never bearish. Yes, eventually there will be a top, but realize how much profit, how many great trades we would be leaving on the table if on the first of the year, and there were naysayers in the first year, the Federal Reserve is not going to cut. They've been yakking since Q4 of last year, as the S&P has gone from 4,700 to 5,400, right? The whole time the S&P, the Federal Reserve is not going to cut. They're not going to cut. They're not going to cut. And worse, maybe shorting it. Opportunity cost is a thing. So please, gang, as long as it's moving higher, I don't need to believe they're going to cut. I just need to see the possibility is there. So when people come back, and I get emails from time to time from folks saying, Rog, I don't know what to believe. You know what? Don't even believe me. I'm looking at the data. And if Fed Fund futures are saying we're going to be lower at the end of the year, it's tough to unwind this expectation of a rate cut, right? Regardless of what the people on television say. They're just designed to keep you tuned in, right? They don't know. They don't know. Believe me, they don't know. I'll tell you this. I was interviewed to be one of the panelists on a show many, many moons ago, right? I don't know where the markets are going to go, but I'm supposed to sit there on that panel and talk like I do. That's the job. What's the job description? Pretend like you know what's going to happen tomorrow. Great, we'll hire you. So yeah, I told you I was salty today. That's where we sit, right? Near these highs. Now, there's a couple other places we can look. Let's take a look at the long bond. Let's take a look at the long bond. Yields are going down. Bond traders are a smart bunch, right? These are not people who are going to be swayed by what's going on TV. Bond traders are pretty smart. I've known a few in my time. They are a smart bunch, and they're a discerning, if not skeptical bunch. And if they see fit to take the interest rates lower, because that's what movement higher on this futures contract ZB tells you, all right, I'll accept the price action for what it is. Currency traders, here is the euro. The euro is really choppy, admittedly. And, you've got the push and pull of 2 central banks, the FOMC and the ECB. But at the end of the day, it's not as if the US dollar is continuing to go higher as the euro goes lower. This is the best way, by the way, to look at the dollar. Look at the 6E. So I can't say there's a lot of clarity on the Euro US, because what we'd like to see on the Euro US is that the Euro 2 looks like the Nasdaq, looks like the S&P is punching up to higher highs, which would mean the dollar is weak because the euro is strong. That's the highest correlation of any symbol on the planet. By the way, this is the largest market. The Euro US and the foreign exchange is the largest market on the planet. There's not even a close second. So if I'm looking at the opinion in other places, okay, so the S&P and the Nasdaq are still flirting with all-time highs. You might say, but Rog, doesn't that have a lot to do with Apple and Nvidia? Look, we've watched Apple almost single-handedly keep the Nasdaq elevated. And that's the nature of high concentration weighting. For a big part of the year, semiconductors, led by things like Nvidia, Qualcomm, Taiwan Semi, carried the Nasdaq as well. So when we understand that we live in a high concentration world, and not all 500 stocks in the S&P 500 really matter, about maybe 10 to 20 of them do because of their weighting. Same thing goes with the Nasdaq. That's an even smaller group, right? So when you take tech in a group of 100 stocks, they're even more influential, yeah? And this is where we sit. Please don't buy into higher highs, but please don't get bearish up here. There's no reason for it yet. And if anyone's realized sell in May and go away is about the dumbest thing anyone could say or do, I hope the price action pans that out as well, right? Sometimes there is apathy over summer because people want to go to the Hamptons, right? Or they want to take a break. Fair enough, but it's not a bearish call. It's more of a reflection of the apathy sometimes people have over summer. But this summer, we're leading into possible rate cuts. And oh yeah, there's an election in November. Do you think people are taking the summer off? Probably not. Not this year. Not this year. So this is where we sit, right? This is where we sit. And I hope that makes sense because look, again, don't take my word for it. Look at the price, look at the data, look at the cooler CPI, look at the cooler PPI, and then look at the response in price action, right? So don't even take my word for it. What I'm hoping to do is just kind of point you in a direction where you say, Rog, no one cares more about my money than I do, and I want to understand, why you're bullish. And we've been bullish all year long, and it's been pretty darn good. Was April tough? Yeah, April was tough. I will tell you, the volatility of April, y'all remember that? There's still a little bit of trauma. But for the most part, May's been good to us, and June's just continuing on with the overall trend higher because of the expectation, not the reality. Remember, we don't trade reality, gang. We trade the expectation of an outcome, right? The markets are always looking ahead, and they're making an educated guess about what could happen. And if we don't get what we think could happen, that's where the turmoil begins. And that's what happened with April. We thought one thing for 3 months, and in April said, nope, right? And then we had the volatility. And then things settled down and people realized, oh, we may not get as many cuts, but we're still likely to get some cuts. Cue the uptrend. And that's where we sit. So, I really, after the Federal Reserve, I really just wanted to step in and say, you know what? Not all the indices are moving higher in the same way. Some indices are going to benefit from tech in a better way. Some indices are going to struggle because of the heaviness in things like energy or financials, even healthcare. And that is disproportionately weighted in the Dow. So if you're wondering, yeah, Rog, do all three of them have to move together? No, and they often don't. Here's a perfect example. This is a 1-year look at the Dow. The Dow has really just been in a lot of chop. Think about the weighting that energy has in the Dow and industrials and transports. And don't presume, and I love Dow theory. Almost everything that I do, all the indicators that I've created is really predicated on a very young Raghee reading about Dow theory. And the only thing about Dow theory that isn't true anymore is that transports lead. That's just not true anymore. And if you think about the Dow construction during Charles Dow's time, he made the thing up, right? Look at the construction. And if you want a really good giggle, I talk about this sometimes in the rooms, go to Wikipedia. They have a history of what the Dow used to look like. The Dow is a completely different creature. The Dow Industrial Average is actually weighted number 1 with financials and number 2 at tech. So when you think about the one tenet of Dow theory, that really doesn't pan out anymore, it's the whole thing with transports. That just isn't true because the Dow is a different weighted group of stocks. That said, the Dow is definitely not something that I'm going to say is in an uptrend. You see that there? Because the components within it are not doing as well as the weighted components in the S&P and the Nas, namely tech, right? Semiconductors, technology, even Meta broke out the other day. We've been trying to get into Google again to the long side. So these are things that we're going to continue to focus on. All right. And yeah, the volatility's been pretty high from time to time. But then think about the fact that every single piece of jobs data, every single piece of inflation data kind of creates a sudden realignment of, oh, are we getting this right? So that's the sort of prickly environment that we're in. Okay. So with that being said, I just hope to just add a dose, not of, oh my gosh, Rog, should we be scared? No, you have the data. Never has being a trader existed on a more level playing field. I know everyone wants to scare you with algos and pools of darkness and whatever else, but I will tell you this, because I've been doing this for over 30 years. Never have I felt that at least I'm on a somewhat level playing field with the information. And that doesn't really make it good. More information is not better. But I knew before, when I would route my order into the pit, they're going to screw me. I knew it. That's their job. My job is to get a good fill. Their job is to get a good fill. And most of the time they were going to win. But as long as I had a good trend, I could absorb a poor fill, right? Electronic trading gave us, right, more control over our order flow. And there's just been so many improvements in retail trading since then, right? The exchange fees have come down, commissions have come down, there's more information, we can route our order flow. Those are things we couldn't do even 25, 30 years ago. So yeah, I'm an optimist. I've never met a rich pessimist. So let's take a look at gold. Gold is still struggling, right? Gold is a reflection of real yields, and gold does continue to struggle. And so I'm not going to be as bullish in gold or gold miners as I was even a month ago. And so keep this in mind. Just because something was working well doesn't mean it's going to keep working well, because just like any good soap opera, and the market is a soap opera, the characters change and the story plot changes. And the story plot has definitely moved away from things like gold and copper. We're just not in an environment where we're seeing that strength that we saw in copper, seeing that kind of resilience we saw in gold. So you'll see then metals and mining, which I loved for 3-4 months, and gold miners, which I loved for 3-4 months. I'm not really talking about them anymore. Why? The story changed, new characters. And really the most resilient has been the semiconductor story and the technology story, SMH and XLK, right? And that's where we sit, right? So again, just remember what most financial media is designed to make you feel, that you are not smart enough to understand what's going on and manage your own money. And really, I look at it this way. What we do at Simpler, what I do in the Sector Secrets Mastery, is the antithesis of that. It's one, they're not that smart. Whoever they is. And two, you can do this just as long as you know what the game is that's being played. So I would steer clear, Munair. I would steer clear of gold for now. I would steer clear of gold miners for now. And that actually extends to copper and metals and mining. All right. And just like that, I guess I've been a little ranty today. But look, I hope you can take away something. You can do this as long as you're looking at what they don't want you to be distracted by. And you look at the price, you look at the size, you look at the trend. So June has been really pretty tradable. The day trading has been really good. So if you're wondering, Rog, what about day trading? Has it been clarifying? I was just talking to a member yesterday. He said, Rog, I'm still kind of struggling with swings coming out of April, May, but the day trading's been great. It actually has been. So let's keep a shorter term time frame if that's where the comfort level is. Rog, I don't really trust where we'll be in 3 or 4 days, nevertheless 3 or 4 weeks. Cool. Shorten the time frame. Shorten the commitment to the time you expect the trade to move in your favor. And that's a really easy adjustment to risk control. All right, gang. Be good to each other. I'll talk with you soon.